Hi everyone and welcome back. This video is all about property versus pension. Both pensions and property, whether buy-to-let or your own home, can deliver long-term growth and both could have an important role to play in your portfolio. But they each have their own advantages and limitations. Let's take a look at property first. The pros. When it comes to picking an investment that is most likely to grow in value over the years, property has long been seen as a good choice. The UK property market has been increasingly on the up, despite the occasional slump, and as property values have continued to soar over recent decades, some investors have capitalised on the trend of building property portfolios worth hundreds of thousands of pounds. In addition, the demand for buy-to-let properties remains high, and because demand outstrips supply, property investment can offer a huge opportunity. Along with rental income, the potential increases in the value of the property over time can deliver a sizable profit when you sell it. This combination of rental yield and capital growth means you have both immediate income and the potential for long-term profits. You also have the option to sell the property at any point and invest the money in other ways. But what about the cons? Like any financial asset, investing in property carries risk. Escalating house prices have often produced a great return, but this isn't guaranteed. When working out the rental yields you could expect, you'll need to consider the costs too, such as maintenance, repairs, insurances, tax and other fees. How much the property is likely to be worth when you come to sell compared to what you paid for is also an important factor. But liquidity may be your biggest problem, how easy or hard it is to get your money out when you need it. Selling a property can take months, so if you're relying on the proceeds for a time-sensitive reason, you'll need to plan well in advance. You'll also need a backup plan in case the sale falls through or the markets crash. Rent alone may not be enough to bring in the income you need, especially if you have mortgages to pay. Also bear in mind that being a landlord isn't an easy job, and you may not want this responsibility over the long term. You could get an agency to handle most of it, but this will eat into your income. Buy-to-let. Investing in the right property, in the right location, with the right mortgage is essential for a high rental return. If any of these factors aren't exactly right, your investment is unlikely to give you the financial results that you're after. Lots of people choose buy-to-let as a retirement income option, often taking money out of their pensions to fund it. If you are considering this though, you must speak to a financial advisor first, because stripping out your pension pot can have big implications and potential tax penalties. Despite some challenges, there are still advantages to buy-to-let today, including you'll earn rental income, though possibly less than in previous years. At the same time, you could generate capital growth as your money grows as your property value increases. You can take out insurance to cover against loss of rental income, damage and legal costs. But you'll need to consider the disadvantages too. Your tax bill will be higher than it once was, eating into your profits. If you don't have the right insurance in place, you might not generate an income if the property is empty. And if property prices fall, your capital will reduce. And if you have an interest-only mortgage, you'll need to make it up for any shortfall if the property sells for less than you bought it for. You'll need to factor in the cost of stamp duty, insurance and wear and tear. And you'll have the responsibility of being a landlord. There are also a number of taxation changes that affect landlords. Landlords used to be able to offset mortgage interest payments against rental income, but in 2015 the government announced this was being phased out, and now it's gone completely. The government has replaced this with a 20% tax credit, which isn't as beneficial for higher rate and additional rate taxpayers. The government increased the capital gains tax allowance for 2020-21 from $12,000 to $12,300. So if you're selling a second property, you get to earn more tax-free. But the capital gains tax rate is higher for landlords. It's 18% for basic rate taxpayers and 28% for higher and additional rate taxpayers. But the capital gains tax system is currently under review, so there may be some further changes afoot. Private residence relief has also changed. Previously, if you lived in your property before letting it to tenants, you'd get private residence relief when you came to sell. This means you wouldn't pay any capital gains tax for the time you lived in the property, plus an extra 18 months after you moved out. But under the new rules, this has been reduced to just 9 months. And lastly, the £40,000 of lettings relief, which you could claim if you rent out a property that's been your main home, will only apply to landlords who share an occupancy with their tenants. Now let's take a look at pensions. The pros. A pension is, simply put, a long-term investment with tax relief. Getting tax relief on pensions means that some of your money that would have gone to the government as tax goes into your pension instead. Most pensions today are defined contribution schemes, though some employers offer salary-related defined benefit schemes, but mainly in the public sector. But both pensions enjoy tax advantages, making them more efficient investment vehicles than many other mainstream products. As you save into a pension pot, it builds up compound interest over the long term. The earlier you start investing in a pension, the more you'll benefit, as the interest itself earns more interest and the whole pot grows faster. If you have a self-invested personal pension, a SIP, you can take more control over the types of investments you hold in it. You can even invest in commercial property via your SIP, so it's not an either-or question about pension or property. You can invest in one using the other. But what about the cons? The only real disadvantage of putting money into a pension is that you can't access it until you're at least 55. But the whole purpose of a pension is to invest for retirement, so this can't really be considered a drawback in my opinion. If you expect to need access to funds before you reach 55, you should be putting your money elsewhere. Your pension will be invested in stocks and shares, so there is investment risk involved, but this risk should be in line with your attitude to risk and is significantly less than with other similar investments since tax relief adds such a sizable bonus. You can also move your pension into less risky investments as you approach retirement age to reduce the risk of last-minute losses. But which has the best tax benefits? Pension contributions benefit from tax relief, and the investments in your pension are free from income and capital gains tax, which can make a significant difference to the value of your pension pot over the long term. The tax rules on property have been getting less generous. When buying a property, you'll need to pay stamp duty, land tax, as well as other fees for conveyancing and surveys, and there's an additional 3% stamp duty charge for residential property if it is in addition to your main residence. This is on top of the normal stamp duty rates that apply for primary residences. In addition, income from buy-to-let needs to be declared on your self-assessment tax return. The tax on your income is then charged in accordance with your income tax band. 20% for basic rate taxpayers, 40% for higher rate, and 45% for additional rate taxpayers. When the time comes to sell your investment property, there may be capital gains tax to pay if the value of the property has risen. So in short, when it comes to tax, pensions win hands down. But which is less risky? Relying solely on property means that you're putting all your eggs in one basket, and that's never a good idea. You'll also be extremely susceptible to changes in the housing market and tax rules, and the location you live in could also have an impact on your wealth. Property investment also comes with potentially high maintenance costs, selling fees and solicitors' fees, and mortgage interest needs to be taken into account. Property price growth has slowed in recent years, making buy-to-let riskier than in the past. If you have a mortgage, you could be left in negative equity if house prices fall, meaning you've paid more for the property than it's actually worth. A pension is more diverse, with different investment options. This helps to spread the risk through diversification. So when one fund is performing particularly poorly, others in your portfolio hopefully do not. But pensions also come with investment risk, and you may get back less than you originally invested. Some defined benefit or final salary pension schemes in the private sector have come under scrutiny recently. The collapse of firms including Carillion and BHS and the effect on their pension funds has led many people to question whether their pension schemes are as safe as they once thought. But pensions are actually protected. However, if your employer does go bust before you retire and you have a final salary pension, you may lose 10% of your pot. If you have a defined contribution pension, it won't be affected even if your employer does go bust, as it's not connected to them in any way. It can lose value if the stock market falls, but over the long term, its growth is likely to be positive, as likely as property growth anyway, which has the better potential returns. In recent decades, property values have shown phenomenal growth. The UK average house prices increased by 8.5% over the year to December 2020 to a record high of 252,000, up from 57,726 in April 1990, according to the Land Registry. But changes in how property is taxed has meant that the big gains from rising house prices may be harder to achieve in the future. With property, rent could boost your profits, with the average rental yield at around 4%. But bear in mind that though UK house prices have grown 34.7% in the past 10 years, the UK stock market has grown by 63.9% over the same period. With your workplace pension, your boss is obliged to pay in a minimum of 3% of your qualifying earnings if you meet the requirements, and the government pays in too. You automatically get a 20% uplift when you pay in, and you could reclaim even more if you're a higher or additional rate taxpayer. In conclusion, pensions retain many advantages over property, including tax relief, employer contributions, in the case of most workplace pensions, lower volatility as they invest in a broad range of assets, and greater accessibility and flexibility. So for me, pensions take the win.